This is the Nichols Patrick Current Federal Tax Developments for the week of December the 5th, 2016. Current Federal Tax Developments are brought to you by Nichols Patrick CPE and your state society of CPAs. This week, we're going to look at defining due diligence, among other things, as we take a look at the developments for this week in federal taxes. Some of the key issues we're going to look at this year will include the Department of Justice has moved forward on their chasing down the Bitcoin users with the serving of a summons on Coinbase. A number of professionals the IRS has announced are going to need to reconfirm their identities to continue to use e-services to obtain transcripts. The IRS raised the cost of installment agreements that will be effective on January 1st of 2017. The IRS also issued a notice explaining to individuals who are participating in the PRMP and the HAMP mortgage relief programs about how far through the process they're going to have to be by the end of 2016 to qualify under the special rule in the PATH Act that would allow them to continue to get relief from cancellation of debt, even though their debt is not formally canceled until 2017. And finally, and probably most significantly, the IRS issued temporary and proposed regulations that are going to deal with the expanded preparer due diligence rules coming up effective for the returns we'll be preparing for 2016. Now, we're getting back into late in the year again, and we're here at the point where you need to get ready for tax season. So we have a few tax updates coming up here in the next couple of weeks that I thought I'd point out to you, depending upon where you are in the country. We have an update here on December 15th. I'll be doing an update for Arizona taxes. That will be both in the Arizona Society offices in Phoenix and webcast. That's a half-day course, 4 hours in the afternoon on the 15th of December. On the 16th of December, I'll be doing a full 8-hour current federal tax developments from Phoenix. That will be also webcast and live. It'll be down at their society offices, plus it will be on a webcast. Bob Gilwey will be doing an advanced tax update in Cincinnati. The advanced tax update is meant for people that have more experience and will look at some of the more advanced issues a little more heavily than we will look at. We talk about a general update course. And Mark Patrick will be presenting the current federal tax developments in Dayton, Ohio on December 20th. So as we head into the middle and toward the latter part of December, we're going to have some options here to get you updated just before you start tax season. So if you're going to be around or in those areas, consider signing up and looking into those courses. Let's take a look at our first update for this week. And this is a continuation of a story that we talked about last week. Again, back to in the matter of the tax liabilities of John Doe's, case number 3:16 CV 06658 from the United States District Court for Northern California. In this case, remember last week we had told you the Department of Justice had filed with that court to be able to serve a summons on Coinbase Inc. This week, the court formally approved the Department of Justice request to make that serving of a summons on Coinbase. Now, this doesn't mean the court has really yet ruled on whether the summons is valid. All the court has done is they didn't find anything obviously wrong right up front with the summons. But Coinbase has not yet raised any objections. They've not had a point in the process to raise it yet because nobody has served them with a summons yet. Coinbase has indicated in the Wall Street Journal article reporting on this week that they do plan to raise objections to this summons. So we may actually get some more details here in the next couple of weeks about whether this John Doe summons will work. One of the most important things to remember, though, is that once the IRS would get a list of people, whether it's the entire list of Coinbase's customers that are in the U.S., or whether it is just some more restricted list. Some people have suggested that the IRS might have to cut this back and only ask for people with transactions over some base level. In any event, once those names are revealed, any of those who have, let's say, failed to report their income from the Coinbase operations would have effectively lost their ability almost certainly to do a voluntary disclosure. And voluntary disclosures can be helpful because those can be done where a deal can be worked out by counsel before you actually come forward, that gets you off of having to worry about criminal prosecution and potentially also limits the impact of penalties that may apply to the transaction. Of course, once the IRS has your name from a summons that's been served, they really don't need your cooperation any longer. And that's why the voluntary disclosure doesn't work, because you're not telling them anything they don't know. For CPAs, one of our big problems is if you get a phone call from somebody suddenly who's read about this online and now suddenly thinks, oh, well, I might have a problem. Please remember, if you are not a member of the bar, you do not have any privilege with criminal matters. And depending upon the nature of what they did with Coinbase or with Bitcoin, not really Coinbase, but with Bitcoin. Coinbase was just how they would convert the Bitcoin into cash when they wanted to buy something they couldn't buy with Bitcoin. The problem becomes that once you know something, you can't unknow it. And that information, even though you have protection in civil cases, you do not have any protection, or they don't get any protection from you having to be forced to testify in a criminal matter. If anybody calls you to suggest that, oh, I need to talk with you because maybe I got a problem, it's very important that you don't get information from them. What I would strongly suggest is saying, look, there may be a problem if you have failed to report income. If that is significant enough, and please don't ask me what significant enough is, they could attempt to charge you criminally. Because of that, I don't want to know any more about this and I have to know. I would strongly suggest that you get legal counsel here locally and get a referral to somebody who handles criminal tax matters or who has worked before, probably in the offshore program, to be able to do a voluntary disclosure, because if you need to do it, that would be the way to handle it at this point. And by the way, the clock's running, because once the service gets the list of people, probably they won't be too apt to worry about doing voluntary disclosure agreements any longer. So basically, just be sure you don't become the number one witness against a potential client. Make sure that you refer anybody here to somebody who is a member of the bar and has some privilege that will actually work even in a criminal matter, because the problem is by the time you figure out if the matter is criminal or not, it's too late to bail. So be careful there. And we're going to keep an eye on this Bitcoin issue going forward. Next up, for those of you who we have a special announcement from the IRS. For those of you who have used e-services to obtain transcripts, we may have an issue coming for you where you're going to be forced to reconfirm your identity. The IRS announced this week on their website in a posting entitled "Important Update About Your e-services account," which they also emailed out to most affected users. They noted that if you have been using e-services to access transcripts, you have done so in the past year, and you basically signed up before May of, in May or before May of 16, so you didn't sign up after May of 16, then you will probably be receiving a letter here in the next month telling you that you have a certain period of time, 30 days from the day the letter was issued, to reconfirm your identity at e-services. If you do not do so, you will lose the right to access transcripts. So effectively, you need to keep your eye out for this letter. Now, the IRS indicated they had begun sending out letters, but they also indicated that they weren't sending them all out at once, so they're going to come out over the next month. If you believe you're in this group and you don't get a letter, this particular notice tells you the things you should be doing. Basically, wait till the end of the month. And if you don't get a letter by the end of the month, you basically should contact the e-services help desk. So if by the end of December you get to 1st of January, you've accessed e-services, you didn't validate yourself after May of 16, then you may want to contact the e-services help desk to make sure you're not about to lose access. What you'll have to do is confirm your identity under the IRS's new program. Now, this particular secure access validation is only part of the entire secure access program. As the notice points out, they are not rolling out the entire secure access program, but they are requiring people to revalidate. Why are they doing that? The problem they've discovered, there have been a lot of phishing emails sent out attempting to get the credentials of professionals who have access to e-services, and some of those have been successful. Now, the IRS is aware of some successful ones, but obviously you can never be sure, as the IRS has probably figured out by now, that we can be sure that none of these people are not who they claim they are. So they're going to be sending out information to force you to revalidate. They would prefer you revalidate online. And if you do so, the one issue there is you're going to have access to a cell phone in your name to receive a code. If you cannot complete that app process online, you'll have to call the e-services help desk. Now, almost certainly, either one of these processes are going to include all of those knowledge-based authentication questions, which they know that a large number of people will be unable to complete. If you are not able to either make it work online or with the help desk where you give the information, then you're going to have to go into a local IRS office in order to revalidate yourself. So if you have been getting transcripts online, keep an eye out for this letter. Take actions to keep yourself in the loop so that you don't lose access. And also be aware that if you think you should have gotten a letter and we get to the 1st of January and you have not, you should contact the IRS's e-services help desk. Next up, the IRS finally pulled the trigger on what they had told us back in August they were planning to do. They have raised the installment agreement fees beginning effective January 1st of 2017. What's going to happen here is the fee for a regular agreement that's entered into in a way other than online will be $225 unless the taxpayer agrees to a direct debit. If the taxpayer agrees to a direct debit, the fee will be $107. If the taxpayer arranges the installment agreement online, the fee will be at $149. And if they agree to a direct debit when doing it online, the fee drops to $31. If you have to restructure an installment agreement, that's going to cost the taxpayer $89. As well, the low income rate will be $43. All of this will be effective January 1st of 2017. So if you work in the collection area, be aware of the fact that installment agreements will get more expensive January 1st. So you might want to try to make sure you get that agreement entered into before that date to save your client a bit of money. Next up is Notice 2016-72, issued on November the 28th. This deals with the special rule contained in the Protecting Americans from Tax Hikes Act passed last year that dealt with the limited extension of time for the cancellation of debt exclusion for home mortgage indebtedness. Congress extended that to apply through the end of 2016, but added a special rule that if a taxpayer had not gotten a discharge in 2016, but had entered into an arrangement that was binding, that would allow for a discharge in a later year like 17 or 18, they could still use exclusion. This particular notice looks for taxpayers who are currently under one of two programs run by the federal government. The two programs that are being run in this case are the Federal Housing Finance Agency's Principal Reduction Modification Program, called PRMP, or this Home Affordable Modification Program, called HAMP. If they are under either such program, then what's going to have to be able to be done is they're going to have to be, a couple things will have to happen. Before January 1st of 2017, a mortgage servicer must send a borrower homeowner under the PMP program a notice in conjunction with a written TPP, or a borrower homeowner in an active TPP, a separate notice in a written opt-out letter outlining the terms and conditions of the permanent loan modification requiring completion of the active TPP. Or 2, the borrower homeowner satisfies all the trial period and PRMP conditions. And 3, they enter into a permanent modification on or after January 1st of 2017. That will be a similar structure will apply to HAMP. So you basically need to have essentially the notice that you've been accepted. You have to complete the conditions, right? And then you have to enter into the final discharge on or after January 1st, or I should say on or after January 1st, 2017. That's how you'll be able to qualify for the exclusion. The notice goes on to remind you that even if a taxpayer does not qualify for this exclusion, there are still the other exclusions that would apply. Most likely you'd be looking at an insolvency case if a taxpayer got a modification. In this case, these are the programs where we reduce your debt, but you continue to hold on to the home. So the taxpayer would receive relief from that. Similar things apply if you're doing other outside of these programs. If you're in a modification or notification with a lender, you'll probably have a similar idea of looking at these types of criteria. Are we far enough along in the program that it's pretty much all over but the shouting? Maybe all we need to do is make sure we stay current for 6 months into 2017, and then we'll have a discharge. If that's the case, then that discharge in 17 will still be considered to be excludable under these rules. Finally, one of the most important things that happened this week, the IRS released the temporary regulations on the expanded due diligence requirements put into law last year by the Protecting Americans from Tax Hikes Act. Last year, Congress decided to expand the preparer due diligence penalties that currently apply to the earned income tax credits, where preparers who prepare returns that erroneously claim the credit, where the preparer did not do due diligence to verify that the taxpayer was eligible to claim the credit, was subject to a $530 penalty. That will now be expanded so that the same rule will apply if you prepare a return where you claim a child tax credit or additional child tax credit the taxpayer is not eligible for, or you prepare a return with a American Opportunity Tax credit where the taxpayer is not eligible to claim the credit. These particular rules, a couple of things they make clear. Number one, it reminds us each of these penalties runs separately. So each credit has its own penalty. If you claimed all 3 credits on the return and all 3 were disallowed and you failed to do your due diligence, conceivably you could have a penalty of $1,590 for that return imposed on the preparer. Now note, this includes a non-signing preparer, because there are rules for that as well. Even if you don't sign the return, but you were involved and responsible for getting the information for this particular credit, you can be assigned the penalty. So that means everybody who touches the return has to be a bit concerned about these rules. It's not just going to go to the signing preparer. The rules tell us what need to be done in order to make these things happen, right? Now, bottom line, if we prepare that, we have to do a few things. We have to fill in and complete the Form 8697, which goes with the electronically filed return or the paper filed return. We also have to keep records of how we got the information to answer the questions on that form and to verify that our client was eligible for these credits. That has to be kept in our files for effectively 3 years after the return is due, or 3 years after we filed the return if that's later. We have to also be ready to, produce that information for the service if requested. One thing to note about this, really, with the way the penalty works on the client who claimed it recklessly, who then loses access to the credit for a number of years into the future, depending upon how reckless they were in claiming the credit. This is setting us up somewhat for the preparer. If they can prove they met due diligence, will pretty much have set up the taxpayer for being penalized and for losing access to the credit in the future. So it's an interesting mess. Apparently, Congress decided it worked on the earned income credit as far as they were concerned, so they're going to try it on these 2 credits. A couple of important things are in here. Number one, there are a set of 7 examples that go through what you have to do to meet due diligence. Now, these examples include some interesting sides. In fact, the first example looked at the fact that you had a 22-year-old taxpayer, never been married, has 2 sons. Based on the input sheet, you discover that, this is a child, qualifying child. You want to kind of make sure this happens. What do you have to do to verify this? And to meet the knowledge requirements, you have to make reasonable inquiries to determine whether each boy is a qualifying child of your client for an income tax credit and for the child tax credit. Please remember, they've got to be a dependent for that purpose, including reasonable steps to verify that your client really is the parent of those children. And you must document those inquiries. Now, example 2 says, if you then go on and you prepare the next year's return, you can use the information you got for doing the 16 return to verify. You know what? If this person was the mother of the child, you verified that last year, seems reasonable to assume she's still the mother this year. So they say you can use that back reference information from last year, but at some point you've got to verify, how did you verify this person had the proper relationship with this particular individual? As well, the next pair of examples says where you found out that this person's never been married, 18 years old, has a child and infant, and she lived with her parents all year. Okay, now our potential problem is she a dependent of her parents? She's 18 years old. That seems reasonably. She's living with the parents. Are the parents eligible to claim her as a dependent? Because if they are, then her child becomes their qualifying child. She can't take the child as a child, and she also can't qualify for the credits, for the earned income credit. So we have to document that we made reasonable inquiries of that. Again, example 4 tells us if whatever we discovered in the first year, let's say she was not a dependent of her parents in 2016, we can use that information to justify the same conclusion in 2017. That's kind of an interesting idea. So you're not required to make additional inquiries, that you're not the parent's qualifying child or dependent. The 5th example, where you have a taxpayer comes in and they claim the right. They said their niece and nephew have been living with them all year, and they want to claim them as qualifying child, get various credits, which they can do, but you have to make some inquiries about the relationship, about the parents, about whether the children actually lived with this person during the year in question, and you must contemporaneously document that information. Next up is example 6. Example 6 deals with the earned income tax credit. And it deals with, you have a 50-year-old woman come in, no dependents. She comes and she tells you she has $10,000 of income on a 1099 miscellaneous. She has no expenses related to that income. Now, what this example makes clear is you have to document that you inquired, did she have other income besides the $10,000 1099? If you haven't been aware, a lot of clients believe if there's no 1099, they don't have to report it. You have to say, no, I need to know any income you had. Number 2, we need to know if she had any expenses related to that income. Some people have discovered that if there's a sweet spot of the amount of income you want to show to get the maximum earned income credit. And if it turns out that your expenses would drop you below that level, some people have been known to leave those expenses off. This makes clear you've got to ask about other expenses that might exist to document that you properly inquired about both the income and the expenses in a case where those expenses or lack of those expenses could make a difference in how much earned income credit could effectively, by leaving them off, could raise the credit received. You can't just say, hey, it's expenses. We don't need to worry about those. You need to worry about them. Finally, example 7 is a bit concerning. This one deals with the American Opportunity Tax Credit. You receive a 1098-T for this year that indicates that, the university billed us $4,000 for tuition-related expenses at the university, and that our taxpayer was at least a half-time student and was an undergraduate student. The problem, of course, is to meet the requirements where they're eligible, you have to inquire about other information to make sure they're eligible. One of the biggest problems we have for the next 2 years, and as pointed out by this example, universities are allowed to continue to report amounts billed, not amounts paid, on 1098-Ts, but your credit's based on the amount you paid. So the 1098-T and the number on it will absolutely not be sufficient to document what the amount paid was for this year for purposes of computing the credit. So if your client has a 1098-T and it shows amounts billed, you're going to have to make a separate inquiry and document how you got this information regarding how much tuition the taxpayer paid as opposed to what they were billed. That is, when did you pay it? How much did you pay, etc., not just what were you billed for the year. That's going to be a problem for this year and next year, because remember, while the universities now have gotten relief from worrying about amounts billed, for due diligence purposes, you're going to have to go find the amounts paid, not rely on amounts billed. While it may be too complicated for our universities, who I have a little concern, they're training the future accountants we're supposed to be hiring. They're not able to figure out what they got paid, but our clients are going to be required, and we're going to be required to force the clients to determine what they really did pay. So be aware of that this year. Everybody should be working on enhanced due diligence requirements. Many of us don't do many earned income tax credit returns. We may have had 1 or 2 of those every year. They were a special case. Now we're going to see a lot more probably child tax credit, especially that type, and American Opportunity Tax Credit credits on returns we file. The child tax credit is going to be especially problematical for divorced parents, because remember, if you can't claim the exemption, you can't claim the credit. And we're going to find a lot of situations where there's going to be a battle over which of the parents can claim the credit, which can claim the exemption that will worry us for the credit. Remember, we have to have, for a non-custodial parent, there must be a signed release. That we have to have the signed release in our hand. The divorce decree is no longer adequate, period. That's simply that ship sailed back a few years ago. So we have to make sure that we've verified that somebody has a right to claim exemption, because if that exemption leads to a child tax credit, that potentially leads to a $530 penalty imposed on us if we cannot show we have met the due diligence requirements. Well, we're now in the time of year where winter has arrived, and we're getting ready, probably thinking about that part of winter that we all get used to, which is starting tax season. But I remind you that your state societies still have classes here through the rest of December and going into January for ways to get yourself updated and ready. A lot of state societies are offering staff tax training courses during this time frame that can be used to get various staff members up to speed. So you might want to take a look at some of those, especially your new staff members. And also take a look at those courses that you might want to get yourself ready for the upcoming season, so that you're ready to process all of those interesting issues you're going to hit here in the upcoming tax season. This has been the current federal tax developments for the week of December 5th, 2016. Be sure to catch our updates during the week on our website, currentfederaltaxdevelopments.com. You can also get a PDF with the articles describing all of today's topics on that weekly update page. If you have any questions or comments, send them to me at edzollers@currentfederaltaxdevelopments.com. You can also follow me on Twitter at edzollers is the way you follow me there. So have an interesting and fun week in the area of taxes, and we'll look forward to seeing you next week as we talk about new developments in the areas of federal taxes.